All right, so we're picking up on learning objective 6.4. We're going to do 6.4, 5, and 6 all together. We're in the home stretch and we're almost done with chapter 6. This will be the last video. Okay, so the next thing we're going to talk about is what we call lower of cost or market. Sometimes it's abbreviated LCM. And basically, we're wanting to make sure that we are not carrying the inventory at too high of amount. Okay, so they give us an example here. Market usually means replacement cost. Okay, there is a bigger calculation to this that we teach in intermediate accounting. So if you become an accounting major, then, or if you are an accounting major, we'll learn more about this later on. But for purposes of this chapter and this little objective, we are just going to look at market value is replacement cost. What can we go buy that item for again today? Okay. If it's a lot less, then we might be carrying it on our inventory at too high of an amount. Remember that conservatism says that we need to take assets down to their lowest amount, liabilities to their highest amount, because we're being conservative, which has nothing to do with political affiliation. Okay. So they give us an example here. We're going to work through it. So it's super easy. We have cost and we have the market. Okay. So Smart Touch Learning paid $3,000 for its tab 0503 inventory. By December 31st, it can be replaced for only 2,200. So there is a decline. So I'm just going to write these over here just because it's pretty simple. Which one's lower? The market is lower here. So we're carrying it. Cost is what we're carrying it on our books as $3,000. But we can go buy another one, a replacement for 2,200. So we're going to have to take that value down for this item. And how we do that, this journal entry should look familiar when we're making a sale and where inventory is actually leaving. This is the journal entry we would make. But here, there's not inventory leaving. It is the cost of that item is we're bringing it down because something has happened in the market. Obsolescence can happen. If you have computers sitting too long in a warehouse, the software is going to go get old, and it's not going to be worth as much. So some things will lose its value, usually from obsolescence. Um, and just, sometimes prices just come down on things. I mean, I used to say I never was going to buy an electric car. I haven't yet, but I can't say that I'm really never going to do that because I might one day, because the prices may come down on it one day to where it's actually affordable. Okay. So these things happen in the real world, and businesses cannot carry that inventory at that higher amount. Okay. So now, whenever they go and they state, on their balance sheet inventory, it's gonna be carried at that 2,200 amount, not the 3,000. Okay. All right. Now we're gonna do learning objective 6.5, and we're gonna look at errors on the financial statements. I'm not gonna spend a ton of time on this. I just really kind of want you to know that errors, if they are left and you don't catch them, they will fix themselves into accounting periods. Okay. What kind of errors could be made? Usually counting the ending inventory. They're going to count the ending inventory. If they do that wrong, then that's going to mess everything up. But like I said, if they count the next year wrong, or I'm sorry, if they count the next year right, it will even itself out every time. Okay. Um, so they give us an example here where ending merchandise inventory is overstated by $5,000. So we have net sales revenue, have everything down to cost of goods available for sale. They counted the inventory, overstated it by 5,000, which understated cost of goods sold, remember cost of goods sold is an expense. We didn't send as much expense to the income statement as we should. So then that means gross profit is overstated. Okay. You got to think about this just a second. Remember, sales minus cost of goods sold gives us gross profit. Cost of goods sold is an expense. So if that number is understated, that's going to overstate gross profit. Okay. Operating expenses, we're just going to say those are correct. Net income will be overstated by $5,000. We don't want to do that, okay? That goes against conservatism. If we were under, it's kind of easier to tell your stockholders, oh, hey, we made a mistake and we have more net income, not less. It's kind of just, it's a psychology in it too. I always say, you know, y'all would hate me if I added a couple of extra homework problems, but you love me if I take them away. So if I take some away that you don't have to do, there's a psychology behind that. Even if both of those ended up being the exact same amount of problems, you would not like me to add to your load. Okay. So now they're looking at an understatement here of inventory. We're looking at a different one. And the understated inventory means cost of goods sold is going to be over, gross profit will be under, and net income will be under there. Okay. So you can kind of see how this right here shows you how an arrow will fix itself. They're going back to the 5,000. And so you can see if they go in there and they count the ending inventory correctly right here in year two, then it will move to the next period correct. That they don't have to do anything. It just will fix itself. What we hope in the accounting world is that it's an immaterial amount. It's not such a huge amount that's going to make a huge difference on whether somebody would invest in the company or would not. Remember, we talked about that disclosure principle earlier in this chapter. Okay, so you can see there is 5,000. These two together was 100,000. Okay, they're kind of off, but we know we're going into the period three with the correct numbers, and they didn't even catch the error. If we can catch the error, yes, we want to do that. We want to be as accurate as possible, but most all errors will fix themselves within two periods. Okay. All right, I'm going to jump on down. I know I kind of told you I don't really do a lot of ratios, but I kind of want to hit on this just really quick because I feel like it'll kind of help you understand inventory. Okay. So there is this inventory ratio. Remember, I'm not making you memorize it, and we just went past it. Okay. So inventory turnover tells us how many times did we sell all of our inventory within a period, most of the time a year. Okay. So if you had an inventory turnover ratio of 5, then that means you sold all of your inventory 5 times throughout the period. Okay. Realize that it's going to be different for different industries. So think about the fact that we buy consumables from Amazon, Walmart, Target. We buy consumables like that every week, every month, at least. Okay. We're a consumer society. So we buy stuff all the time. How often do we go buy a new couch? Me and my husband have been married for 30 years and we are only on, I think, our fourth set of couches. I need a new set, just can't find the one I want. But we haven't been buying that. We don't buy new computers. We don't buy, you know, appliances, washer, dryer, refrigerators. We don't buy those all the time. So you're going to see an inventory turnover much lower in places like Best Buy, Furniture Row, or things like that. Walmart, Target, Kroger, they're selling they're even selling perishable things that have to be sold fast. Okay. So you'll see a higher inventory turnover for businesses like that in that industry. Okay. That's really all I wanted to touch on. I didn't really even want to go through the mechanics of it too much because I mean, I'm not testing y'all over that. I just kind of thought it would help you just a little bit understand um, inventory and just kind of think about how different businesses have different types of inventory. Okay. And I think that is it. We're not doing this last learning objective because it is periodic inventory. We're not doing that one. All right. We are done with chapter 6. I will see you in chapter 7.